Good afternoon. Welcome to Foundations of Investing. We have all heard that investing is simple but not easy. We hear so many things on how to invest, where to invest, so many stock tips, so many tips about investing in mutual funds, so much about real estate and all asset classes. Because of social media proliferation, a lot of confusion has also been created around investing. Many do not know how to begin. So today in Foundations of Investing, what we'll be exploring is a simple approach for wealth creation. Before we begin, if there are only 3 rules that you must remember to be a successful investor, those would be these. In a high nominal GDP country like India, equity always gives the best returns over long periods. What this means is when the nominal GDP growth is high, growth is also happening because of increase in the size of the economy, and growth is also coming from inflation. Now, in an inflationary environment, amongst all the asset classes, which are debt, equity, gold, and real estate, equity is best placed to give you higher returns. The second thing you must remember, which is a quote of the legendary Howard Marks, is that the best time to buy any asset class is when nobody else wants it. When the whole world wants a particular asset class, naturally prices are going to be inflated. You have to be patient and wait for the right time to buy something when nobody else wants it. The third thing that you must remember as young people or students is that you should start investing as soon as you start earning. If you take a look at the 3 charts below, over days, your portfolio will look very volatile. It will be up on the first day, it will be down on the second day, it could be up on the third day again. Over years, that line smoothens out. And over decades, you will observe that the chart is upwards. So if you are a student, you are beginning your professional journeys, you are a young professional, you should start investing as soon as possible. Let us now look at the 4 asset classes. The first asset class is debt. Debt provides stability and capital protection. Examples of debt investments include bonds, fixed deposits, debt mutual funds. We have all heard about these. These provide fixed rate of returns. For example, bank FDs will provide you 6 to 7%. Debt mutual funds will provide you slightly more. Bonds may provide you slightly more than that. The second asset class is equity, something that we have all heard about. Equity helps you build capital because it grows at a faster pace than debt. Examples and sources of equity are stocks, of course, equity mutual funds, ETFs, etc. The third asset class is gold. Gold is something that every Indian household has invested in. It is an uncorrelated asset class. By uncorrelated, it means that its value does not necessarily move in accordance with the values of other asset classes. So it provides some stability to your portfolio. You can get exposure to gold asset class through gold mutual funds, gold ETFs, SGBs, and even physical gold. The fourth asset class is real estate. Real estate provides both capital growth and diversification because again it is uncorrelated with all the other asset classes. While you can directly buy real estate, it becomes a sizable investment. So a better way to get exposure to real estate is through REITs which are listed on the stock market. The basic tenet of investing is don't put all your eggs in one basket. We have all heard this. Now let us take a practical example and understand how this really works. Let's take a look at the period from March 2nd to December 7th. Equity as an asset class, which is our equity markets, gave 443% returns. The debt returns on the other hand were just 39%. If you are an investor starting out your journey at say, December 2007 or Jan 2008, you would think that, okay, equities has given the best return, so I should invest all my money in equity. What would have happened then in the next 5 years? Take a look at the second line in the table. From Jan 8 to March 13, equity returned negative 7%, but debt returned a positive 41%. What this means is, had you put all your eggs into the equity basket, you would have faced a loss of 7%. Hence, it is important to place your eggs in multiple of these baskets or asset classes as we call them. Let's take a look at how these asset classes have given returns in the past. This is a chart showing returns for the period 2002 to 2021. The blue line that you see is returns from equity. So 1 rupee that was invested in the markets in 2002 has become 15.5 rupees in 2021. The gray line that you see is gold. It has increased 7.5x. The orange line that you see is bond, which has increased four times. So let's examine what would have happened had you invested at the top of every cycle in the market. Let's take a look at 1992. This was when the markets were at the then all-time highs. If you had put in money then, your money would have become 13x. Right? Let's take a look at 2000, the IT bubble. If you had put money in equity then, it would have become 12x today. Let's take a look at the next height of the cycle, which is 2008. Had you put in money then, it would have become 3x. Right? So it's very simple, right? The chart is showing that equity is always growing. So why not just start putting your money at the height of every bull cycle and not worry about your entry price point, right? So this is a popular trap in which retail investors fall. So let's take a look at this meme where we all know the popular character Chatur from Three Idiots. He doesn't want to understand the strategy. He just says, I have understood if I invest at the top, I will still make money. But does this practically work? Right? We have seen the chart works, but what about human psychology? Human psychology is something that cannot be backtested. Our own emotions make sure that all these past returns that we are seeing in fancy charts don't really materialize. If you had invested at the very top, right, this is what would have happened. Right? Market would be down, but you would be more down than the market, because when the market falls and equity is very volatile, you need to have the emotional bandwidth to stay invested. I do not know of a single investor who has stayed invested from 2002 till date without booking any profits or losses. Psychologically, what happens is once the market falls, we are tempted to take our money out so that we don't incur further losses. If we stay invested, our money would obviously grow, but our emotional baggage prevents us from doing that. Right? So what is a way to counter all of these psychological emotions, emotional baggage, etc.? The answer is a very, very simple approach of a wealth creation roadmap. Right? It has these steps. You start off by knowing your current position. Whenever you are starting off, there obviously needs to be clarity on the starting point. You estimate your risk profile. My risk profile, my emotions are very different from yours, and you need to assess where you fit. The next step is to target an asset allocation. By asset allocation, we simply mean X percentage invested in equity, X in debt, and X in gold, right? And we will see as we go along in detail how you can come across your own target asset allocation. The next step is you've decided, okay, I'm going to invest X% in equity, but within equity, where do I invest? So you have to optimize your investments in each asset class. After that, what you have to do is rebalance. We'll see this step in greater detail as we proceed. And wealth creation will be a natural outcome of this process. Right? Now, you will see a flag in the presentation just after the wealth creation unit. That is because wealth creation is a continuous process. This cycle has to keep on repeating. It's a journey and not a destination. Let's take a look at the first step in detail, which is know your current position. There are some actions you can take and some quick wins here. If you have already invested, whether through recommendations of friends, distributors, etc., you have to know where your investments are. A quick tool that you can use is the NSDL and CDSL or the CAMS cash statement, which gives you a consolidated summary of your entire position. A quick win here is if you have any loans other than a housing loan, please clear off your loans before getting into equity as an investment asset class. The second thing you can do is create an asset allocation. You can use a tool like Excel. This is as simple as saying, okay, I have got 50 rupees in an equity mutual fund, I have got 40 rupees in a debt mutual fund, and 10 rupees in, say, gold ETF. So your asset allocation is 50s to 40s to 10. So you can use a tool like Excel to create this. Right? The third thing to do is you should have an idea of the time horizon of your financial goals. Financial goals are always finite. An example of a financial goal is maybe I want to go for post-graduation 3 years later and I need, say, 20 lakh rupees for it. So a goal has to have these characteristics. It has to have a finite timeline, it has to have a purpose, and it has to have an amount. Once you have written down what is the goal or what is the purpose for which you are investing, your roadmap will become clearer. Now let's look at the second step, which is estimating your risk profile. Right? Now, how is your risk profile determined? Let me tell you, your risk profile is not determined by your age. Many people have this misconception that if you are 20 years old, then you can just do a simple 100 minus 20, where 20 is something you put in debt and 80 is something you put in equity because you have a longer horizon. Let's look at financial goals in detail. I may be a young student, maybe I'm 20 years old, right? So I have a long horizon in front of me. My risk-taking appetite is more. But I may want to go for a post-graduation 3 years later. If I invest my post-graduation savings in equity and the market were to see a down cycle in the next 2 to 3 years, I would be at a risk of not being able to meet my goal. What this means is when your financial goal is closer in horizon, you should have more allocation towards debt. When your financial goal is longer in horizon, if you remember I had started out at the beginning of the presentation, you should have more allocation in equity. So today, if I have a goal of say my children's marriage or my children's education, that's a longer term goal and I'm going to invest in more in equity for that. If my goal is maybe a holiday 1 year later, I'm going to invest more of debt in that. The second thing that determines your risk profile is your emotional quotient. Right? Happiness is a very important factor in investing. You have to be able to have a good night's sleep without worrying about your portfolio value. If you are able to tolerate ups and downs in your portfolio value without any panic, without any mood swings, then of course your risk profile is higher. If the smallest of crashes in the market makes you worry, then of course your risk tolerance is lower. The third and final aspect is actually own past behavior. You will find a lot of questionnaires online which say find your risk profile by answering 5 or 6 simple questions. But frankly, what you answer in a questionnaire versus what you act in real life are two very different things. So ask yourself, what did you do when the market crashed in March 2020? If you bought more equity then, it means your risk profile is higher. If you panicked and sold, that means your risk profile is lower. So your risk profile has to be, I'll say, guesstimated and not even estimated from these three factors. Now let's look at in detail in the next step, which is arriving at your target asset allocation. There are two factors in which you can arrive at your target asset allocation. One is, of course, your emotional quotient and other things like I discussed. Let's assume that I am a very high risk tolerance investor. So my allocation is say 70% equity, 25% debt, and 5% gold. But I'm just starting out to invest today. Now the markets are at an all-time high. Does it mean that I put entire of my 70 rupees upfront into the market? The answer is no. So the target asset allocation has to be arrived at over time. I could invest few rupees every month and arrive at my 70-30, 70-25-5 goal over the next 5 to 6 months or even a 1 year horizon. Right? Once you have determined this, you would know what your asset allocation is. And please be aware, there is no perfect answer. There is no penalty for doing a 70-25-5 versus a 65-25-10. All you have to do is decide one thing and be consistent with it. Now let's look at optimizing in each asset class. Say I have arrived at my asset allocation 70-25-5 and now I'm deciding where do I put in my 70 rupees in equity. You can either research yourself if you are a finance student or if you have time to research as to which stocks or which index funds, etc. you must invest in. Or you could follow somebody who has seen market cycles. When you are looking at somebody else's portfolios to determine where you should invest, please be aware that your emotional quotient and that person's emotional quotient has to match. You can't blindly follow a legendary investor saying he's bought so I'm going to buy, because his risk tolerance will be far higher than what yours can possibly be. You should keep 15 to 30 stocks at most, because beyond that, it's very difficult to monitor what is happening in those stocks. Anything more than 25-30 stocks, you are just better off owning an index fund. You should look for sector allocation within equity. Right? Even within this 70 rupees example which I gave, it is important that you diversify amongst sectors. Should you invest everything in technology? No. Should you invest everything in textiles? No. Keep a balanced approach. Out of this 70 also, you can just bifurcate that into units of 10, and each 10 you invest in each diversified sector. You should avoid some kind of stocks. This is where stock tips etc. come in, and you have to really emotionally hold yourself back from acting on these. Avoid real estate stocks with land bank stories. Land bank stories are those which say that, oh, the developer has so many acres of land and this is going to get developed over the next 5 years and value will be created. These are all stories of bull market. History has shown us many of these just fail. You should avoid M&A target stories. This particular company is going to get acquired by so and so company, so let's buy this company and create value. All of this works in bull markets. It's not sustainable. You should also avoid companies where promoters are reducing their own stake. Promoters are the biggest legal insiders. They have direct insight on what is actually happening in the company. So any company where the promoter is reducing stake, it's not prudent for you as an investor to enter. Let's look at further more things in optimizing equity asset classes. You will see a lot of distributors selling alternate exotic funds, PE funds, etc. These are reserved only for more mature, experienced investor. If your investable corpus is anywhere less than 5 crores, these are best avoided for you. Right? There is enough and more in the equity and mutual fund space for you to explore rather than looking at these exotics. You should remember while investing in mutual funds that mutual funds come with something called as an expense ratio. Higher expense ratio eats into your investments, so you can avoid high cost mutual funds. You also have to be aware about distributor conflicts. There is a concept of direct mutual funds and regular mutual funds. Direct mutual funds are those where you invest directly with the asset management company, that is at the source. Regular mutual funds are those where you go through a distributor. Obviously, the distributor has a commission in between, which reduces your returns. I'm not at all saying that buying through distributors is wrong, but you must be aware that when a distributor tells you to invest in a particular mutual fund, there is an inherent conflict of interest. As long as you are aware of the conflict of interest and you are aware that this particular mutual fund is part of this asset allocation and meets this goal, you should be fine. Let's look at optimizing the second asset class, which is debt. The first thing you must do is get rid of any high risk FD or corporate bond. There have been a lot of defaults in the corporate bond segments in India. Some large cooperative banks, some also large housing finance companies. So you should be aware that any high risk corporate bond, while the nomenclature is fixed income, you could also lose your capital despite it being called fixed. Provident fund is a superb tool which not only gives you an interest rate better than FDs, but also is tax efficient. So if you have not allocated anything towards debt, the first thing that you must do is exhaust your provident fund limit. The other thing you can do is if you have money lying liquid, you can invest it in savings bank account or FDs with scheduled commercial banks which offer a higher interest rate. It is better than the money lying just idle. In the history of India, not a single scheduled commercial bank, no matter how big or small, has failed. Let's take a look at the step called rebalancing. Now, like I had said in the beginning, nobody has the emotional capacity to hold on. So typically people tend to sell when the market is down out of panic and tend to buy when the market is high because of euphoria. Let's examine how we can use rebalance to avoid this sort of emotional baggage. Let's say I have a target asset allocation of 70, 25, 5. The market moves up phenomenally, like it has happened from March 2020 to March 2022. Automatically, the value of my 70, which is equity, will go up, right? Because the market has risen up. That 70 may become 85. Right? While debt will remain more or less there because debt grows at a slower pace. So my 70, 25, 5 has possibly become 85, 10 and 5. At this point of time, I should reassess. If you remember, I said wealth creation is a process. So let us go back, revisit my target asset allocation, which is 70, 25 and 5. And now I am overweight 15% on my equities. So a logical thing to do would be to sell some equity and buy some debt. If you repeat this process over time, you will realize that you end up selling higher and buying lower. Let's take a reverse example. Let's say the market falls and my 70, 25, 5 comes down to something like 50, 45 and 5. Right? So it has become, my 70 has become 50 because the markets have fallen. Right? At this point of time, it would be prudent that I sell some of my debt allocation and move back my allocation to 70, 25, 5. Again, in this example, you will see that you have automatically bought equity when it was at lower. Continue this process, ride out all the cycles, maintain your target asset allocation, and you will see that wealth creation is a natural outcome of the process. In conclusion, let us take a look at some very popular sayings. Equity allocation should be 100 minus age. This is a snippet of knowledge that a lot of people keep talking about. And as we have seen, your risk appetite has nothing to do with your age. You could be a young student, so by this formula, your risk appetite could be more. But like I said, you could be saving for a course that you want to do, which means that you should be investing in debt. Or on the other side, you could be a senior citizen, and by this formula, it would mean that, oh, you are a senior citizen, now you should invest more of your money in FD. But you could have met all of your life goals. Your children are married, they are educated, they are settled, you have enough corpus to take care of your retirement. So why should you not invest in equity and transfer the wealth that has been created to your next generation? So equity or risk tolerance has nothing to do with your age. It has more to do with your emotional quotient and how well you can handle ups and downs. Insurance is a great tool for investment. This is another common misnomer. Right? We get sold a lot of plans saying that, look, this is an insurance cover. It also gives you fixed amount of return. You will actually be better off if you buy insurance separately and if you invest separately. With this, you are optimizing your money. Premiums on term plans, which is the simplest and purest form of insurance, are far lower than what you would get in something like a ULIP. The excess premium which you have saved can just get invested in an index fund, and you would realize over a few years that your returns are significantly higher. Let's take a look at the third misnomer. Tax optimization is most important. All of us fall for this and try to optimize taxes. While tax optimization is important, please remember you only pay taxes when you make returns. So returns is something you should be focusing on foremost. So any investments you should first look at, are they within your risk return metric? Only after that look at optimizing your taxes. Don't try to over optimize taxes. You will end up compromising returns. Let's look at the last one, which is my favorite. You can allot a small part of your portfolio for thrill. After all of this, you would be thinking, this is such a straitjacket approach. It sounds very boring. I have to look at my asset allocation. Where's the thrill? Where's the fun in this? My friends come and tell me, buy this stock, it's going to double. So do I not act on that? So in your asset allocation, you can make a small play for 1%. In my example, instead of having 70, 25, 5, I can have a 69, 25, 5 and keep a 1% for thrill. And by thrill, what I mean is, okay, some hot stock, some growth stock is going up. I may allocate 1% of my money to that. Right? So with this, you ensure that investing journey is fun and not boring. Right? With that, I will conclude my lecture. I hope you have gained some value from this. Thank you.